Good evening and welcome to the weekend edition. My name is Peter Resnicek from ShadowTrader.net. Extremely tumultuous week in the markets this week. We made some new all-time highs coming into Wednesday, whereupon Thursday morning we had some dovish economic data which pushed markets to new all-time highs before selling off very sharply, which brought us into Friday that had big bank earnings before the open, some hawkish economic data taking futures down below that prior day's low, only to rally very, very strongly and make yet another new all-time high before the day was over. So lots to unpack this week. As always, the charts are going to tell us exactly what's really going on. I'm always excited to bring this content to you every week, but some weeks I'm more excited than others. I just feel like there's so much to unpack and so many important things we could talk about in this video. And this one right here for today is going to be one of those videos. We're going to be touching upon what's going on behind the scenes in terms of market internals, market profile, to try to help traders give some clues to navigate this market that is becoming essentially very, very tumultuous, at least what we saw over the last few days with large reversals coming out of nowhere. I'm in an enviable position in that I speak to so many different types of traders all the time through my various advisories that I get to have a pretty good idea of what's going on in terms of people, especially newer traders who are either making money, losing money. And I can tell you I definitely received a lot of emails this week from people who got chopped up, either got overly short on Thursday or something, thought there was going to be follow through. Friday obviously took most of that back. So we're going to get into that really, really deep when we get into the lead story today. But first, let's just look at a very simple technical picture, just straight TA, candlesticks, etc., as we always do, kicking it off with the S&P daily here. Again, these are the 3 days in question, which is obvious. Wednesday, Thursday, Friday would happen. Wednesday was an extremely strong rally day in the markets. Thursday was when we got the economic data pre-market that I was saying had more of a dovish tone to it, in that it was the consumer price index print that was more dovish, right? Indicating that inflation was coming in. That caused the markets to rally to new highs again on Thursday. However, those highs didn't last. It seemed to be very short-term oriented. We'll get into that in a little bit. And the markets fell hard and closed very weak on Thursday. Interestingly enough, Friday morning was actually data that was more hawkish. It was a PPI print that was going in the other direction, saying that producer price index, was increasing a little bit, which would indicate more inflation and a more hawkish Fed. Yet the sell-off on that number at 8:30 a.m. on Friday was extremely muted and lasted for about 2 minutes. Literally, futures just dove down below Thursday's low, rallied right back up, and then staged a very large rally for the rest of the day, all the way up here, making a new all-time high before closing, I would say just about before the midpoint of the range. So my overall take here is very, very choppy. This is a little bit, I would say, confusing from a technical basis, to say the least. However, the key areas that I've been talking about on these charts continue to be intact and not violated. As I've been saying over and over in these videos, keep it simple, right? 2 moving averages and trend lines. Nothing more. So we're continuing to follow the 8 here. That's the green dotted line. And what's very noteworthy is that the stronger selling on Thursday never took out the 8 in the S&P. Now on the NDX it did, and we're going to get to that in a second. The NDX is showing definitely a little bit of relative weakness to the S&P right now. But the fact is that even that selling on Thursday was not able to take the 8, and so far we have no movement below the 8. So from my perspective, we do not have any sort of a short signal in the S&P as of yet. Onto the NASDAQ 100, same time frame daily chart. And as I was saying, this is a little bit more relative weakness than the S&P. And I need everybody to pay close attention for that. Remember that everything that is discussed in this show, everything that happens in the market, in the indices, in different groups, in market internals, etc., everything is a data point. And all data points need to be carried forward in a narrative. You should be keeping an ongoing narrative, if not written down, then in your head as days go on and on, right? All the different data points have to come together. And in this NDX, as I was saying, definitely some relative weakness, but most importantly, we got the breach of the 8. And that hasn't happened in a while, and that's very, very important. Notice that Thursday's closed well below the 8 EMA, and also I think that the action on Friday was obviously weaker than it was in its S&P counterpart, because notice that there was no new high made in NDX. So NDX is a little bit more tech-centric. Remember also that after the June rebalancing, every month the sectors and weights change per spglobal.com, we are now up to 30 32.4%, I believe, of XLK in the S&P. So technology has a huge weight, and we're going to get into that in the next segment. You're going to see just how much that technology is starting to really have effect on the S&P. I should say has been having an effect for quite some time, but that effect has been more and more exacerbated and heavier as time goes on, as that weighting increases. So if there's a chance of a short here in this market next week, I can tell you right now that I believe it's going to be led by technology. It's going to happen in the NDX, and you're basically just going to be looking for a signal below the Thursday's low, I would say, right? It was a relatively weak close on Friday. I would just basically draw this line here, right around 20,200 there. And more than likely, if we hit that, we're going to tumble about 200 points lower in the NDX because these prior highs here are coming in right at the big round number of 20,000. Notice that this was an area that the NASDAQ 100 had difficulty breaking through. So obviously, if that level is breached where we came down on Thursday, I think the obvious move is going to be at least that 200-point move to here, maybe lower wherever this 21 catches up. But remember, my MO is never to call the big call, say from here all the way down to here. I trade in chunks, in segments. I trade weekly options every week, and I'm always putting on new positions and taking off positions. So for me, everything is all about A to B, B to C, C to D, oh, now D goes back to C, etc. So I take it in chunks. So my TA is telling me that if we lose that Thursday low, more than likely the odds favor at least a move to that 20,000. I think that that big round number in the NDX is going to be a magnet, and you're probably going to see some support right around that level. Watch that closely next week if it happens, because if we don't get any sort of a bounce at that 20,000, then that 21 EMA, which is coming in around 19.9 right now, right? That 21 EMA around 19.9 is probably going to be your next stop in the NASDAQ 100. Continuing on with everything we've just discussed, I felt it was extremely important at this juncture in the markets to make the lead story this evening when to short this market, because I know that that's on the minds of lots of traders. I know that some people tried to short the market on Thursday, probably into the close, got burned, and it didn't really work out. First thing I want to tell you right here, right now, is that this is in no way a top call. I'm not really a top caller. I'm not trying to say this is it, because I don't know if this is it, right? We haven't yet seen things happen in the market that are going to confirm that this is indeed some sort of even a short-term top. So just remember that. I'm not calling for some sort of top. What I more want to do in this video is show you some nuance that I feel you might not be aware of that will give you a lot more market-generated information so you'll be able to navigate the market much better going forward, right? So to that end, first thing I want to talk about, there's actually two specific things that I want to talk about, but the first one I want to discuss is market divergence. And this is a subject that we've been talking about in this video for about a month now. If you recall, about a month ago, I started saying that this market is not going to come down hard because there's just too much strength in other sectors besides technology. And we saw that again this week. Let's go over to this slide here that I created, which is a snapshot of what my market internals looked like on Thursday at the close. Now remember, Thursday was the very bearish day that closed at the lows. This was some of the greatest divergence that I have ever seen in my career as a trader. I thought it was amazing, and definitely we need to talk about it. And there was also a lot of people that emailed me that were a little bit confused about how the market could be down so much with the internals so strong. So I want to touch upon that as well. But first things first, let's just look at the divergence of the sectors of the 11 groups in the S&P. And again, remember, this snapshot was taken after the close on Thursday, right? Look at your sectors here from left to right, starting with technology, ending with real estate. The first thing you want to notice is how many were dark green. Remember, the dark green means that those sectors were ahead more than 50 basis, up more than 0.5% from the open. And if they're dark red, that means they were down more than 50 basis or 0.5% from the open. So right off the bat, you notice financials, healthcare, industrials, energy, utilities, materials, real estate. Look at how many sectors were so positive on that day. So this was clearly a day that was more rotational than all out selling. I've said this many times on the program, and I will die on this hill, so to speak. When the market is really in a bearish move, when there is big selling, that is going to be something more systemic, meaning that there is a reason why longer term traders, hedge funds, pension funds, insurance companies, whatever, are liquidating stocks and want to decrease their exposure to equities. This market was more of a rotational market where some of the froth was coming out of technology and at the same time moving into financials, healthcare, industrials, and others. So you want to keep that in mind at the same time. Look at the breadth up here. This is interesting. The relationship between up volume and down volume on Thursday at the close was 4.5 times up volume than down volume, meaning that there was 4.5 times more volume going into up stocks than down stocks. And on the NASDAQ, that number was 1.83 positive. So almost 2 times the amount of volume on the NASDAQ was going into up stocks rather than down stocks. And the advanced decline lines were actually quite strong on that day. If you notice that on the New York Stock Exchange, it was 1,975 stocks advancing more than declining, and on the NASDAQ exchange it was 2,110. So before we go deeper into this, let's just unpack a little bit why these internals were so strong on Thursday in contrast to price action that closed very, very weak that day, as we know, and felt like it was pretty strong selling when indeed under the hood it certainly was not. And I think Friday's action obviously proved that it really wasn't, right? So the first thing you want to remember is just a simple fact that some market internals, not all, but some of the stuff on this page, this stuff up here, okay, these boxes up here, which is the breadth and the advanced decline line, those are the ones that are in, so to speak, the quad, which we used to use. Now I use this, which is called the sidebar. This is like quad 2.0. It's much, much more powerful, I think. So I've abandoned the breadth and the advanced decline line as a main internal, but I keep them up here anyway to give me some idea of what's going on. Keep that breadth and keep that AD up there. Those numbers are coming to us from the exchange, not from the index. Remember, exchanges have thousands and thousands of stocks, right? Indices have how many stocks? 2,000 in the Russell, 500 in the S&P, 30 in the Dow, and 100 in the NASDAQ. Those are very, very small groups. When we talk about the market being up or down, or market was up 1% today, or market did this, market did that, we are never speaking at the exchange level. We are always speaking at the index level, right? We're talking about what did the S&P do, what did the Dow do, the Russell, the NASDAQ, etc. So right off the bat, you have to understand that there is a huge disconnect very often between what is happening on the exchange level and what is happening on the index level. The reason why these numbers are so positive on Thursday is the simple fact that if you look at these groups that were moving hot and heavy to the upside from the open, there are many more stocks altogether on the exchange in financials, healthcare, industrials, real estate, materials than there are in technology and discretionary and communications. It's that simple. If you look at it by weight, these three sectors, like you know that this is 32.4 plus 10 in the discretionary, that's 42.4 plus roughly another 10 in communications. So you're over 50% of the market, right, in the sectors that were going down. And if you add these up, it's less percentage, right? You're talking about 47% or so of the market, right? So obviously the price action in the indices is going to be going down, but when you're reading things from an exchange level like up here, you're going to get these types of readings. So it's very, very important to understand that each market internal is its own data point, and also to understand where does the market internal come from? Does it come from an exchange level or does it come from an index? And this is why I've always been saying that the weighted AD here is so powerful, right? This is something that we came out with a few years ago for sale on our website. Absolutely worth its weight in gold, I think. The weighted AD is measuring this in a more graphical representation, right? The weighted AD is taking the sector action from the open of XLK, XLF, XLV, XLC, etc., from technology all the way to real estate, assigning the proper weight to each index and then charting that histogram from the open. And obviously those were pretty firmly negative, as you can see on the day. And finally, your iceberg tick down here, this is on the New York Stock Exchange. And again, this confirms what I was saying, is that you had so much strength on Thursday in the other sectors that look at where your tick readings registered here. As a matter of fact, I have a little box here that tells me what the high mark and the low mark is of that day. Low mark of that day was only 657. Think about that for a moment. Just let that sink in. Many of you, even if you don't use these tools, you're familiar enough with the NYSE tick to know that minus 1,000 is the reading that you should be seeing, right? If the market is coming down when it's selling, it should be banging against that minus 1,000 multiple times. On a day like Thursday, you probably should have had at least 4 to 5 to 6 or whatever multiple minus 1,000 ticks. Not only did you get 0 minus 1,000 ticks, again, the low tick of the day was 657. So that's also telling you a lot about the nature of the market, right? So the first thing we're going to talk about here is all this, just to sort of encapsulate in terms of when should I short this market or when should you short this market, is you want to see much more confirmation on the downside than this. If this is what it looked like on Thursday, you can probably day trade it short to the downside, but it's probably not a good idea to expect that the next day or the next few days are going to continue to be bearish, because this is the type of price action, or I should say these are the types of underpinnings of the price action that are not going to have downside follow through. When the market is selling harder, nothing is safe, and these sectors here, all of these 11 boxes would be dark red. And the 2 boxes up in the upper left, they'll be red as well, because that breadth will be negative. The amount of volume that's going into stocks that are down is going to be much higher than the amount of volume going into up stocks. And those advanced decline lines as well are going to be negative. They're probably going to read more like minus 2,000 than plus 2,000. So keep that in mind. So the first thing in terms of when to short the market is make sure that there's confirmation from the sectors and all of the internals, and simply understand the difference between a rotational day, right, and then an all-out bearish day. Now, the second piece of the puzzle that I want to talk about is a bit more nuanced, but it's extremely important when you're trying to decide if a market has potential for a larger move lower. And that is basically the concept of balance and excess. And this is where it gets a little bit more granular in terms of I'm starting to show you things that are happening under the hood, just like we kind of did in the last part about the market internals. But here's where we talk about what's happening inside of the actual candlesticks. Remember that this program always begins with the what's really going on segment, and we just look at simple TA, right? We look at chart patterns, S&P and NASDAQ, and we see what those chart patterns may or may not be telling us. But remember, inside of each of those bars is a wealth of information, and that information comes to us through the market profile. Now, of course, I'm not going to get too deep into the profile. That is obviously a discussion maybe for another time. I just want to talk about 1 or 2 very, very key concepts that I think can be very, very helpful to you. So this picture that I put up here, this is actually the ES market profile from Wednesday. And this is very, very important. These are ES E-mini futures. And all you need to focus on really is just these 2 things that I annotated here, where it says close all the way up here, because we know that Wednesday was a strong close. That's the little red box. And this one here that says POC. POC means point of control. And to break it down, all that is simply is that is the level on the ES chart where the most volume traded in that particular session. So right off the bat, some major light bulbs should be going off in your head right now, because if this is Wednesday and we closed all the way up there, why was the most volume in the session traded all the way down there, right? That should tell you something, right? That tells you immediately an immense amount of information about the nature of the players that ran the market all the way up on Wednesday. They were momentum traders, right? That's how momentum traders act, and momentum traders generally are smaller than longer term traders. And this is also how they act, by pushing prices high, by not supporting the bid and buying on the offer and chasing. So people were chasing prices on Wednesday, closing it really strong, but notice that not only did the volume not migrate up with price, notice that the profile got thinner and thinner all the way up to here, where it made a spike in the last period. Each one of these letters is 30 minutes. In the last 30-minute period, it was a huge spike, telling you what? Lots of emotion. That's the type of activity that reverses relatively quickly, because those people are weaker hands. So this is really setting the stage, basically, coming into Thursday, is how all these weaker hands were pushing the market so much higher without the confirmation of the volume and time spent behind it. All right, let's shift over to this next slide here, and we'll continue on with this discussion. Now that we understand a little bit more about balance excess where volume is. Volume should follow price in order to confirm it. I want to talk a little bit more about those points of control, because this is sort of the other side of the coin that may actually be pointing to a move lower. I call it virgin points of control, which is an old concept in market profile. And I just wanted to, first of all, illustrate it with this first slide. Where the highest volume node is, right in here, meaning that where the most amount of volume traded in any futures session, that becomes your point of control. A normal market will always tag that point of control, almost always, in the subsequent session. You can think of it like sort of tagging up, right? Like you have to run back to first base before you can continue on and keep going. It's the same thing. Most markets do this all the time when they're acting normally, or I should say, when they are controlled by longer-term players in a rally that are supporting the bid, because bigger players do not chase the market. They don't buy all those shares they need at market, right? They buy on the bid, they support the bid because they want to beat the VWAP, so to speak, right? They make these decisions by committee and they have a trading floor and then they tell the traders what to do, and the traders need to essentially buy what's necessary lower than the volume weighted average price on the day, because if they can't beat that number, well, they don't have much of a job there, right? There's no purpose in keeping that person on, because anybody could just push the button and buy those stocks at market, right? So if you can't even beat the VWAP, you really have no business being on the trade desk, right? So that's how a market acts when a rally is being supported by longer term players, right? When the market is less supported by longer term players, you start to get what we call VPOCs, or virgin points of control. The virgin points of control are simply those that are untested, meaning that in this example, for instance, I took a snapshot of July 8th and July 9th. Down here at about 56.24, the most volume traded on July 8th. And as you can see, this is the regular trading hour session of 9:30 to 4 on July 9th, and it didn't come anywhere near that. So that is a virgin point of control in that sense, okay? Now, in general, these VPOCs, they don't mean that much when you have one here, one there. You know, it happens every now and then, and the market will get ahead of itself and not test these levels. But it starts to become noteworthy when they start to stack and you start to get about 5 to higher. I like to always think usually around 7 is the magic number. In my experience, all the years that I've been trading, when I notice that when these virgin points of control start to stack up below us and we have about 7 of them, the market is very, very susceptible to a larger break. So let's go over to the next slide here, and I want to show you. Here I've put together all of the virgin points of control. Basically, real simple, these are the ES price levels in the future where the greatest amount of volume traded on these particular days, and none of these days were tested. And I will tell you, coming into Thursday, we actually had an extra one. You see 5 on the list here. We had 6, so it was getting very close to that dangerous level. Like above 5, I start to take notice. If I see like 7 VPOCs below us, I'm much more tentative about taking any sort of long positions. So the 6th one did get corrected on Thursday, but we've still got 5. So what I want to say is that going forward, if the market continues to make very momentum-based advances like we've seen, right, and starts to stack more of these VPOCs onto this list where they don't get tested, that's going to be something to pay attention to, right? A market that keeps going higher and leaves all these virgin points of control in its wake is one that is probably unsustainable and will be subject to some sort of a larger break at any given time. Whether that larger break turns, or I should say, whether that break or liquidation break turns into a larger move lower, right? That's impossible to say at the moment, but that's when we switch to our more simple tools that I show you over there in the other chart. That's when we switch to what are the moving averages doing? Where are we in relation to the 821? Where are we in relation to trend lines, et cetera, right? All you have to do then is just switch your focus to simple TA and see which signposts, so to speak, are getting taken out, and that's going to tell you if you have a market that's more potentially short or not. And last but not least, if you are a futures trader, mark these levels down right now as you're watching this video, because if there is a larger break and you are a futures trader and you want to hold stuff overnight, these are your targets, okay? These eventually, almost always, eventually get taken out. If there is some larger bear move, you're gonna see at the very least, probably these top 3, which are relatively new here in July, down to at least 55.34, you're gonna see these levels get taken, and these should be your targets on any larger downside move. If this sort of thing is of interest to you and you think it can help, I just want to remind you, I write a report about exactly this thing, about the market profile, the VPOCs, etc., every single morning, called Peter's Pre-Market Perspective. I've been keeping this extremely inexpensive ever since its inception, $20 a month. You can also take a 5-day free trial on our site. Address is right here in the Chiron, shadowtrader.net/PPP, and that'll give you access to my everyday morning video, about 3 to 5 minutes, and my full market profile pre-market perspective report, which deals with all of the information that we just talked about now, looking through the S&P futures through the lens of the market profile, which gives us just an immense edge over players, I feel, who are not looking at that market generated information. Okay, we've covered a lot in this video, but before I leave you, of course, I got to give you at least one good idea going forward. So our number one draft pick this week is the Russell, small caps. I didn't do that many trades this week in my weekly option advisory. We had a bunch of short call stuff that worked out really well, and that was just sort of rolling off into expiry on July 12th. But what we did do is we did buy a spread on IWM, which is the ETF that controls the Russell 2000. We also bought a bond position going all the way out to December in the TLT. Why did we do that? Because those are both interest rate sensitive instruments, right? As the market is telegraphing that rates should be coming down now, at least with some of this inflation data coming out a little bit cooler. So we're interested in small caps, which tend to do better in that environment, and bonds. So let's step over to the chart over here and take a look at IWM and see where we're at. I purposely left this on a weekly chart just to show you how big this advance was. A lot of this happened in the gap towards the end of the week, but obviously you don't see the gap in the weekly chart. But you can see that bonds, or rather IWM has had difficulty breaking through this 210 level for a while. There's been a lot of choppy action here. And I think it's kind of noteworthy that rates have actually been relatively high for a while. They haven't come off really at all, maybe a little bit. You're starting to see the 10-year back off a little bit. And you've started to see, you know, Russell stocks, small caps kind of move up a little, and then in this long consolidation. Whenever you have a long consolidation, I'm always interested because obviously balance leads to excess and back to balance. I like to think of it as pressure. Consolidations build pressure, and that pressure has to be released. And in this case, it looks like the pressure is being released to the upside. So for us, we just took a relatively short-term view on this for next week. We are long the 210, 213 call vertical, which you can see is already fully in the money for us, which is great, but we have to wait till later on to get more extrinsic value out of it. So that trade is doing good. But I think this is something that traders can look at for longer term. Much like my position that I believe bonds are going to trade much, much higher into the end of the year and into 2025, small caps could actually be that play as well. So just keep that in mind. There may be some opportunity here in the IWM and in the Russell for a long trade going forward. And that's all for our show this week. Thank you as always for spending a little bit of time with me. Hit the like and subscribe buttons and the little bell to be notified when we post new videos. We are trying to get up to 100,000 subscribers, and obviously we can't do that without your help. So thank you so much. If you can do that for us, we would definitely appreciate it. What was this video all about this week? Just to recap, do not short a market unless you have some confirmation from the underpinnings. And remember that a lot of those underpinnings can give mixed signals, and each one is just one data point. And in order for a larger move to emerge, you have to have all data points coming together at the same time. Remember, there are longer term signals in the market. There are shorter term signals in the market. A lot of that we talked about, like with the futures market, when things get out of whack. All of that stuff is very, very important. Just make sure to carry everything forward in your narrative so that you can make the best decisions as possible when you are starting to trade. All right? Coming at you from Los Angeles, California. I wish you good trading and good night.